In this week's video, we'll review the latest charts to help us understand why history has a clear message about stock market performance between now and year-end. In the financial press and on social media, 365 days a year, if you look for it, you can find bearish forecasts and lots of gloom and doom. September 2021 is no exception. Headline from Yahoo Finance: suddenly everyone thinks the stock market is going to plunge. Remember, in last week's video, we looked at basic trend concepts using the 50 all the way out to the 100-day simple moving average, and we compared the peaking process before the dot-com bear market and the financial crisis bear market to the look of the S&P 500 on September 10th. This week, we're going to do something very, very similar, but from a different perspective. This is the S&P 500 on September 15th, 2021. On September 15th, 2021, we were 541 calendar days from the major low that was made on March 23rd of 2020. Similar to last week, we have arbitrarily picked simple moving averages to illustrate basic concepts, starting with the 50-day moving average in blue, all the way out to the 250-day moving average in silver shown on your screen. If you've been involved in the world of technical analysis for quite some time, you know the look of this chart is rare. This is an extremely strong and unabated trend in the S&P 500. Thus, we wondered, how rare is it? And in past instances where something similar has happened, where we've had a low and then an incredibly sharp rally with a similar profile, what happened next in the stock market? Do the historical cases align with present-day thinking in September of 2021 that the stock market is going to plunge? And if so, when and what type of pullback in terms of magnitude might we expect? So the first thing we're going to do is take this chart and shrink it down to a smaller size. We went back and walked through the S&P 500 with these moving averages. We started in the late 1940s, so we basically are walking forward from 1950 and looked for similar trend profiles. Based on relatively simple selection and elimination criteria, we zeroed in on these 8 historical cases shown on your screen. Starting in the upper left-hand corner, 1950, 1955, 1959, 1963, 1984, 1995, 2013, and calendar year 2017. Very, very similar to the profile in 2021, the years shown speak to the right side of the screen. And in each case, the market is 541 calendar days from a low. So this point here is 541 calendar days from this point here. The same can be said A to B here in 2021. To provide one anecdotal example of how periods were eliminated, 1987, if you walk forward from the low that was made on December 4th of 1987, and you walk forward 541 calendar days, which in the present day takes us to September 15th, 2021, in the 1987 case, you have not yet exceeded this high. That is significantly different from what we're experiencing in the present day. On a September 15th, 2021, this is rear view mirror territory here. In the 1987 case, the market is still down here below the S&P 500 level in August of 1987. You can see in each one of these cases, the level on the right side of the screen exceeds these highs here on the left side of the screen. Just from a pure pattern recognition standpoint, you can see even the 8 similar cases on our screen, none of them are identical to the pattern in the middle of the screen. And that's exactly what we would expect. We're looking for similar periods. There are no 2 identical periods in human history, and the same applies to the stock market. Thus, given the stock market's come an extremely long way since the low in March of 2020, it's logical to ask and answer, how did the stock market perform in each one of these 8 cases walking forward from a point similar to September 15th of 2021. And since on September 15th of 2021, the day we're comparing the historical periods to, is 107 calendar days from year end, might be helpful to know that the gain in each one of the historical cases over the next 107 calendar days on average was 6.2%. The median gain, very, very similar, 6.4, with roughly 88% of the historical cases seeing the S&P 500 higher 107 calendar days later. Hypothetically, that would take us in the present day case to December 31st of 2021. How about the longer term outlook, 1 to 5 years? Once again, the historical cases, the similar historical cases, the results in the S&P 500 were very, very favorable. Average gain 1 year later, 15%, 2 years later, 29%, 3 years later, 36%, 4 years later, a little bit over 60%, and 5 years later, the S&P 500 on average was higher by 81%. 2 years later, 3 years later, 4 years later, and 5 years later, the S&P 500 was higher relative to this hypothetical point here in 2021 every single time. Which takes us back to our opening slide and opening concept. Does the look of the S&P 500 and the strength of the trend in the present day align with the position that suddenly everybody thinks the stock market is going to plunge? We already know the answer in terms of between now and year end, hypothetically, based on the historical cases, and looking out 1 year, and looking at these results here, it's pretty easy to say that it strongly contradicts this headline here. How about maximum drawdowns, looking out 107 calendar days and 1 year? Do these numbers align with or contradict the headline on the upper left-hand corner of your screen? Well, given the average drawdown looking out 107 calendar days was less than 2%, and the median drawdown was roughly 1.6%, fairly easy to say, once again, we're in the contradict element relative to the historical cases. And the 1 year drawdown average 3.01%, the median drawdown less than 2%. And as always, none of this is meant to predict anything. It simply helps us assess the probability of good things happening relative to the probability of bad things happening. And the fact that we're talking about the probability of bad things happening means we readily admit, regardless of the historical analysis that we just covered, bad things can happen. And relative to the incredibly muted drawdowns that we've had year to date, a 3.5% drawdown between now and year end, or a 4% drawdown between now and year end, would most likely psychologically be pretty painful. Thus, this analysis helps us keep realistic expectations about 100% normal and to be expected volatility that occurs even within the context of the strongest trends. And even if really good things happen over the next 1 to 5 years, the maximum drawdown in the historical cases was 8.13%, the 1959 case 6.9%. Just as there's been 100% normal and to be expected volatility between the low in March of 2020 and the present day, even if really, really good things happen walking forward, and we are in the context of a secular trend, have to have realistic expectations about how markets operate in the real world. On the other end of the spectrum, the study also helps us with the concept of trading the chart in front of you, because in many of the historical cases, look how shallow these maximum 1 year drawdowns are here, where my cursor is, where I'm highlighting these numbers, relative to walking forward 1 year from a point that's similar to September 15th of 2021. Realistic expectations work in both directions. It's not healthy if we think the stock market's going to plunge and we have no openness to extremely bullish outcomes. Conversely, it's not particularly healthy if we feel like the market's going to be higher every single day and that we're never going to experience any type of drawdown again. Something else that's noteworthy from a psychological perspective. This is the 1955 case. Very, very similar to the present day. Psychologically, it's very, very easy to say in September of 2021, there is no possible way that the stock market can keep marching higher in the short to intermediate term. We absolutely, positively need a pullback, or the market is ignoring this or that. Need and ignore can be dangerous terms. This is a steeper trend here, a more extended trend in calendar year 1955. This ascent here looks totally unsustainable on September 27th, 1995, which is 541 calendar days from the low in the rearview mirror that was made in 1994. What happened in these cases? And frankly, this chart is scarier here. This chart is scarier here relative to this somewhat muted slope compared to this point and this point. In these cases, was it helpful to ignore the chart in front of you, which at this point looks healthy and at this point looks healthy? In both cases, the answer is no. The maximum drawdown over the next 107 calendar days in the 1955 case was less than 4%. The 1995 case basically never looked back, less than a 1% drawdown from the point similar to September 15th of 2021. Similar situation in two cases, the maximum one-year drawdown, 3% and less than 2%. And being overly bearish right here and overly bearish right here didn't work out particularly well from an asset allocation perspective either. In the 1955 case, the gain over the next 107 calendar days was an additional 13.9% from this point here. And even in the 1995 case, the additional gain over the next 107 calendar days was 3.57%. Over the next year, an eye-popping additional gain from this point here of 18.04%. Once again, highlighting the importance of staying in the now and trading the chart in front of us. The quote on your screen is very, very similar to the concept that excellence can only be created in the now. It is impossible to change trades that we've made in the past, and it is impossible to make trades in the future. The only thing that we can do is trade the chart in front of us. The information that we need to assess probabilities is right in front of us on the chart in front of us. In all three of these cases, we could have said the market needs to correct, the market needs to correct, the market needs to correct. The market needs to correct, the market needs to correct, the market needs to correct. The market is overdue for a correction, it's overdue for a correction, it's overdue for a correction. The concepts here and the concepts here align nicely with trying to take it day by day while keeping an open mind about a wide range of outcomes, from wildly bullish to wildly bearish, allowing us to maintain that all-important maximum flexibility. Because without it, it's impossible to properly trade the chart in front of you. Back to the Yahoo Finance article dated Monday, September 13th. In the orange box, about 90% of Russell 2000 stocks have already fallen into a correction, according to Bloomberg. Russell 2000 small cap stocks. It may or may not be noteworthy that while 90% of Russell 2000 stocks have already fallen into a correction, the Russell 2000 index hasn't plunged. It's basically been consolidating. And history tells us it is not unusual for a market to get extended from the 200-day moving average, as the Russell was in February of this year, and then to pause and move sideways until the 200-day catches up. Now here's the key. You still have to trade the chart in front of you. Typically, when you get to this point, as you might imagine, one of two things happen. You either break out to the upside or you break out to the downside. But right now, this chart absolutely positively keeps the door open to breaking out to the upside. This is one of the weaker indices out there. Think about that. And it still has just been moving sideways. In fact, we're well above this low here from January of this year. And relative to this big move, point A here to B here, we're well above the 38.2%, 50%, and 61.8% retracements. All of that is subject to change, but it hasn't changed yet. As we know, the charts that we've been covering so far this week were dated September 15th. How significantly different does this chart look during Friday's session? The answer is not very different at all. This is the 50-day moving average here in blue on the chart that we've been referencing during the entire video. Here's the exact same 50-day moving average during Friday's session, September 17th at 11:15 a.m., when the S&P 500 was down 28 points. If you want a broader view of the same chart during Friday's session, here it is. This is 9:46 a.m. on Friday, September 17th, when the S&P was down 9. Ultimately, the research that we conduct each week is intended to help us manage money to the best of our ability. And to do that, we're trying to understand risk and reward. Thus, it will be helpful to know, in the present day, if we experienced between now and year end a drawdown similar to this column here. So we'll be taking the drawdown from the close on September 15th, 2021. What would that look like? Here's the answer. This chart is dated 9:57 a.m. on Friday, September 17th. These are the same moving averages that we've been using for this week's analysis. These dotted horizontal lines show you the hypothetical drawdown in the present day from the closing price in the S&P 500 on September 15th if we experienced something similar to the 8 historical cases that we've covered. And if we zoom in on this chart, this is the lowest of the dotted horizontal lines here, just a hair under 4,300. If that were to happen, which would be the worst case scenario in the historical cases that we've covered, we would stay above both the July low in the S&P 500 from 2021 and the June low. And clients and regular viewers know that aligns with the research that we've been conducting in recent weeks and months, which has been telling us continually from a probabilistic perspective that it's not unreasonable to think when a larger pullback comes that the market could right itself either near the June low 2021 or above the June low. And the research from this week draws the same basic conclusion. In April and May of this year, we had a very short-term consolidation pattern here and then a bearish breakdown. To give us an idea of what a pullback to this level, which would be the worst of the 8 historical cases hypothetically, if we saw something similar in the present day, if we pulled back to this level. It's also noteworthy. If we take this rally from here to here, so just a few short weeks or a few short months, even a normal, 100% normal and to be expected pullback that would occur within the context of an existing and ongoing bullish trend, that would keep us above the 61.8% retracement of this move from here to here, meaning wouldn't be particularly damaging even to the intermediate or short-term trend if we pull back to this red line here, which would be in line with the historical cases that we've covered. Ultimately, this is the objective, the box right here. We're not trying to predict anything, that the market's going to pull back or that it's not going to pull back. This gives us a base case or some guideposts to manage against. If the S&P 500 moves into this area here or this area here, it doesn't mean we start to panic. It just tells us that we would become more prepared relative to taking defensive action. Any pullback in this area here that stays above, let's say, 4,300 or the July and or June low, the default would be to try to do nothing. Why? Because every single one of these horizontal dotted lines coincides with an existing bull market. And in each one of these cases, after this pullback here, the market went on to print significantly higher highs. over the next 107 calendar days in most cases, and over the next year. There are a couple of exceptions. But 88% odds relative to the historical cases, that's pretty favorable. Said another way, the default here is to try to do nothing based on what we know today, as of September 17th. All of this is subject to change. Comments are based on what we know today and based on the data that we have in front of us today. Based on what we know today, the default is to try to do nothing above this level and this level. And that's a general comment. There may be some individual positions that we need to manage, but generally we would try to do less rather than more between this point and this point. Again, why? Because the whole concept of a bull market is that bull markets make higher highs after pullbacks. Bull markets tend to make higher highs after pullbacks. And if we get a pullback in this region here, or even back to the June low here, it really doesn't deviate from the base case script. And if you're a client, especially a relatively new client, it's extremely important to note, we haven't decided how we're going to handle anything in the future. Just as we did over here, if you watch the videos, our videos in this area here, we really weren't expecting anything like this. And yet we were still able to mitigate this drawdown and manage risk. And that's where the maximum flexibility comes in. Nothing wrong with being bullish at this point here, as long as you're willing to acknowledge when things start to change, and as long as you're willing to take action when things start to change. Things could start to change in the present day very, very soon, but once again, they haven't changed materially yet. And for the most part, based on what we've covered in the past several weeks or months, that would be true if we moved all the way back to the June low, which is around 4,200, 4,180-ish on the S&P 500. The model continually asks, are we allocated properly based on the evidence in front of us today? Are we allocated properly based on the evidence in front of us today? If the evidence changes and we need to make adjustments, we will do so. When you take a weight of the evidence approach, basically what you're doing is you're saying, the research that we've conducted this week, does it align with or contradict the research that we've covered in past weeks and months? And one way to check that is, let's take these 8 historical cases, which would be these charts over here on the left side of your screen, and put them on this secular bullish trend chart that we've been covering numerous times in recent years. Covered it on April 2nd here, where we took research that we conducted in April of this year. This happens to be an LPL research piece here where my cursor is. In this case, the dates inside here, all of them highlighted in yellow, occurred within the context of a secular trend in the S&P 500. Now let's take the 8 dates from this week's research and do the same thing. Let's take these 8 dates and put them on this chart, and we've done so with these green highlights. Once again, every single one of them occurred within the context of a long-term or secular bullish trend in the S&P 500. A long-term or secular bullish trend in the S&P 500, and what we believe to be a long-term or secular bullish trend in the S&P 500. And if that's the case, and that is the base case, and the research from this week aligns with it, it doesn't contradict it in any way, then if we want to get to the right side of this table here, then we have to be willing to withstand 100% normal and to be expected volatility that occurs even within the context of the strongest bullish trends. It would be wonderful if the stock market behaved as it has really in the last few weeks or months. Typically, you're not going to get something like this perpetually going forward. If you take the time to look at these cases here, there's a ton of volatility between point A and point B that could be several years down the road. Thus, if we want to capture the gains, we have to understand volatility is a normal part of the markets. From one of the most successful traders of our time, markets are fundamentally volatile. No way around it. Your problem is not the math. There is no math to get you out of having to experience uncertainty. Uncertainty and volatility and being uncomfortable are part of all trends, even bullish trends. All bullish trends have counter-trend moves. In each one of these cases, there's a lot of volatility between point A and point B that could be several months or several years down the road. We're not the only ones that think we're in a secular trend. Why is that? Because that's how markets operate. And if you study markets and are experienced, you're going to draw similar conclusions if you're doing it in a scientific manner. This week's research says we should be open to relatively muted drawdowns between now and year end and over the next year. It's basically the same conclusion in this tweet from Fidelity here, the director of global macro over at Fidelity. As this chart shows, secular bull markets are not immune from recessions and cyclical bear markets, but they tend to be shorter in duration in terms of days, weeks, months, and years, and shallower in terms of the magnitude of the drop. This is during secular bear markets. This is the look during secular bull markets. You can pause your video player. And this tweet is very, very recent. Came into the feed this week. It starts with, I still believe that we are in a secular bull market that is far from over. Take this statement here on the left side of the screen and compare it to this table here. Does this align with or contradict the research that we've covered this week? We can only trade the chart in front of us. And the best way to do that is to take it day by day while keeping an open mind about a wide range of outcomes, from wildly bullish to wildly bearish. And if we're going to handle a situation like this effectively, or if we're going to handle a situation like this effectively, we all know the only way to do it is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.